You know that feeling when you finally hit $10,000 in savings and you think you've made it, but then you realize you're still stressed about money every single month? Most people think crossing five figures is the finish line, but there's actually another threshold at $20,000 that completely transforms how money works in your life. That number is where the math stops feeling like a grind and starts feeling like magic. My name is Key Invest, and I spend way too much time thinking about money, financial psychology, and why some people seem to effortlessly build wealth while others work just as hard but never get ahead. If you're someone who wants to understand the real mechanics behind wealth building instead of just hoping things will magically improve, make sure to hit that subscribe button and give this video a thumbs up if it ends up helping you see money differently. Now, before we dive into why $20,000 matters, let me ask you something. Have you ever noticed how people who cross $10,000 in savings celebrate for about a week, but then nothing really changes in their day-to-day life? They're still worried about expenses, they're still living paycheck to paycheck, just with a slightly bigger cushion. That's because $10,000 is an important milestone, don't get me wrong, but it's not quite enough to fundamentally alter your financial reality. Here's what actually happens. Most people think that the journey from $0 to $10,000 and the journey from $10,000 to $20,000 are basically the same thing, just another $10,000 to save up, right? Same discipline, same sacrifice, same timeline. But that's not how it works at all. The second $10,000 does something completely different to your brain, your opportunities, and your entire relationship with money. And understanding this difference is crucial because it determines whether you keep building momentum or whether you plateau and stay stuck at that $10,000 level for years. Think about it this way. If you've ever tried to push a boulder up a hill, you know that the first few feet are absolutely brutal. You're straining, you're sweating, and you're wondering if this thing is even going to move at all. But once you get it to a certain point, once you build enough momentum, the boulder starts moving more easily. You're still pushing, but now the momentum is helping you instead of fighting you. That's exactly what the journey from $10,000 to $20,000 is like. You've already done the hardest part by proving to yourself that you can save. You've built the habits, you've developed the discipline. Now those habits start working exponentially in your favor. But here's where it gets really interesting. The psychological shift that happens at $20,000 is completely different from the one at $10,000. At $10,000, you finally feel like you have a safety net. You can breathe a little easier. A car repair won't destroy you. At $20,000, something much more profound happens. You stop operating in survival mode and start operating in opportunity mode. And that shift changes absolutely everything. Let me explain what I mean. Research from Vanguard shows that households with less than $15,000 in liquid savings spend approximately 40% of their mental bandwidth just managing financial stress. That's not bandwidth they're using to think about growing their money or finding opportunities. That's bandwidth consumed by worry, by anxiety, by the constant mental calculation of, can I afford this? What if something goes wrong? How do I make it to the end of the month? $20,000 might not sound like much in the grand scheme of things, but that amount creates a massive psychological shift because it represents roughly 3 to 4 months of expenses for the average person. That's not just an emergency fund anymore, that's runway, that's breathing room. That's the difference between your brain operating in threat detection mode and operating in opportunity recognition mode. This isn't just about having more money sitting in your account. It's about fundamentally changing the questions you ask yourself every day. When you have $5,000 saved, you're asking, how do I protect this? How do I make sure nothing bad happens? When you have $10,000, you're asking, how do I survive until the next paycheck while keeping this intact? But when you hit $20,000, you start asking completely different questions. How can I make this money work harder for me? What opportunities can I take advantage of? How can I accelerate this even faster? Let's break down the actual mathematics because this is where things get wild. Let's say you're earning $60,000 per year and you're managing to save $500 per month. That's not easy. That takes real discipline. Getting to your first $10,000 takes about 20 months when you factor in some modest investment returns. Almost 2 years of consistent effort, saying no to things you want and staying focused on that goal. But here's the part that will blow your mind. Your second $10,000 doesn't take another 20 months. If you're investing that money and earning a reasonable 10% annual return, getting from $10,000 to $20,000 only takes about 16 months, 4 months faster. Why? Because now you've got that first $10,000 working alongside your monthly contributions. Here's the exact math. At $10,000 invested at 10%, you're generating about $1,000 per year in returns. That's $83 per month that you're not having to save from your paycheck. So your $500 monthly contribution effectively becomes $583 per month when you include returns. And the crazy part is, this acceleration keeps increasing. By the time you're going for your third $10,000, getting from $20,000 to $30,000, the timeline shrinks even more to about 14 months. That $20,000 is now generating $2,000 per year in returns, which is $167 per month. Your effective monthly contribution is now $667. The same effort, the same $500 from your paycheck, but the results keep accelerating. Let me show you how insane this gets over time. Once you hit $100,000, which sounds impossible right now, but stay with me, you're generating $10,000 per year in returns, assuming that same 10%. That's $833 per month. At that point, you can add another $10,000 to your net worth in just 6 months, even if you don't contribute another penny from your paycheck. The same amount of money that took you almost 2 years to accumulate initially is now happening automatically in half a year. Now, you might be thinking that wealthy people have access to some secret investment world that lets them earn these returns, while regular people are stuck with savings accounts earning 0.5%. And while there is some truth to that at the ultra-high end with private equity and hedge funds, it's not what's driving this phenomenon for most wealthy people. The real secret is much simpler and honestly much more encouraging. It's just basic mathematics working in your favor. A low-cost index fund that anyone can open with $100 has historically returned about 10% annually over long time periods. Wealthy people use the exact same index funds, same strategy, same time frame, same risk level. The only difference is scale. If you invest $1,000 at 10%, you make $100. If someone invests $10,000 at 10%, they make $1,000. If someone invests $100,000 at 10%, they make $10,000. Same investment, same percentage return, but completely different dollar amounts. That's it. That's the whole secret. They're not smarter than you. They didn't find some hidden investment strategy. They just got to a higher number first, and now the percentages work more favorably in dollar terms. But here's the part that most people completely miss, and it might be the most important point in this entire video. The journey to $20,000 doesn't just change your bank account. It fundamentally changes you as a person. And this might sound like some self-help nonsense, but stick with me because this is where things get really practical. Think about what it took you to get to $20,000. You had to develop discipline, you had to track your spending, you had to say no to things you wanted in favor of things you wanted more, you had to stay consistent month after month even when it felt pointless, even when your friends were out enjoying life and you were sitting at home eating leftovers to save money. That process shaped you. You proved to yourself that you can delay gratification. You proved that you can set a goal and achieve it. You proved that you can control your money instead of letting it control you. This identity shift is huge because it affects every financial decision you make going forward. When you see something you want to buy, you don't just think, can I afford this? You think, do I want to spend my savings on this? That's a completely different calculation. One is about possibility, the other is about trade-offs. One leads to impulse purchases and regret, the other leads to intentional decisions that align with your bigger goals. I'll give you a concrete example. Before you had significant savings, buying a $5 coffee might have felt like a harmless treat. After all, it's just $5, right? But once you've saved $20,000, that $5 coffee represents something different. It represents the discipline you had to exercise to accumulate that money. And suddenly, spending $5 on something you could make at home for 50 cents feels less appealing. Not because you can't afford it, but because you now understand the opportunity cost in a way you didn't before. But here's another psychological shift that happens at this level that most people don't talk about, and it's possibly even more powerful than the identity change. You start seeing opportunities instead of just threats. When you have less than $10,000 saved, Every unexpected expense feels like a disaster. Your car needs new brakes? That's $500 that completely derails your month. Your laptop breaks? That's $800 that sets you back weeks in your savings progress. Your dentist says you need a crown? That's $1,200 that feels absolutely catastrophic. At $20,000, these same situations feel completely different. They're annoying, sure, but they're not threats anymore. They're minor inconveniences at worst. A $500 car repair is 2.5% of your savings. It's barely a blip. More importantly, these situations no longer consume your mental energy with panic and stress. You handle them and move on. But here's where the opportunity mindset really kicks in. When you're not constantly worried about survival, you start seeing opportunities that were always there but that you couldn't take advantage of before. Your friend mentions they're starting a business and looking for a small investor. Before, you would have had to say no, even if you believed in the idea.
Now you can actually consider it. You can run the numbers, you can make a calculated decision to invest $2,000 or $3,000 if it makes sense. And here's the thing. Most successful businesses started with investments from friends and family. Those early investors often see returns that dwarf what you can get in the stock market. But you can only participate if you have money available. Someone at work mentions a rental property their family is selling below market value. Before, you couldn't even entertain the idea. Now you can at least do the research. Maybe it works, maybe it doesn't, but you have the option to explore it. Your boss announces a professional conference that could advance your career, but it costs $1,500? Before, that would have been impossible. Now, it's a decision you can make based on whether it's worth it, not whether you can scrape together the money. This is what wealthy people mean when they say money goes to money. It's not some cosmic conspiracy where the universe favors rich people. It's that having money gives you options, and options create more opportunities, which create more money. It's a flywheel effect that you can only access once you reach a certain threshold. And $20,000 is where that flywheel really starts spinning. Here's something else that happens at this level that seems counterintuitive at first. You start caring less about small expenses and more about big ones. I know that sounds backwards, but hear me out. When you're struggling to save, you obsess over every dollar. Should I make coffee at home or buy it? Should I bring lunch or eat out? Should I cancel Netflix to save $15 per month? These decisions consume enormous amounts of mental energy. And sure, they add up. If you spend $5 on coffee every workday, that's about $1,300 per year. That's not nothing. But once you hit $20,000, you start to realize something. That $1,300 per year, while not insignificant, is not what's going to make or break your financial future. What matters way more is where you live, what you drive, how much you save, and where you invest. These big decisions have 10x or even 100x the impact of your daily coffee choice. A person who lives in a modest apartment, drives a reliable used car, and consistently saves 20% of their income can absolutely afford a daily coffee habit without it affecting their wealth-building trajectory. Meanwhile, someone who lives in an expensive house, drives a new luxury car, and only saves 5% of their income will struggle financially, even if they make coffee at home every single day. This shift in focus is incredibly liberating because it frees up mental bandwidth for the decisions that actually matter. You stop sweating the small stuff and start optimizing the big stuff. And ironically, this often leads to better financial outcomes than obsessing over every tiny expense. Now, let's talk about what happens to your career once you hit this milestone, because this is huge and almost nobody talks about it. When you have less than $10,000 saved, you're basically trapped in your job. Your boss could be terrible, your coworkers could be toxic, you could be underpaid by $10,000 or $15,000 per year compared to market rates. But you can't leave because you need that paycheck. You can't afford even a small gap in income. This puts you in an incredibly weak negotiating position. You can't ask for the raise you deserve because what if they say no and now things are awkward? You can't push back on unreasonable requests because what if they decide you're not a team player? You can't explore other opportunities because what if you leave and the new job doesn't work out? The fear of financial instability keeps you stuck, and your employer knows it, even if they don't consciously think about it. At $20,000, everything changes. You now have what people call walking away money. You have enough saved that if your boss is unreasonable, if your workplace becomes toxic, if you're not being compensated fairly, you can actually leave. You have 3 to 4 months of runway to find something better. And here's the beautiful paradox. Once you have this walking away money, you often don't even need to use it. Just having it changes your entire demeanor. When you ask for a raise, you're no longer asking from a position of desperation. You're negotiating from a position of choice. Your confidence shows. Your willingness to walk away if the answer is no shows. And employers respond to this. They know that good employees with options are worth keeping. When your boss asks you to work late again on a Friday, you can push back if it's truly unreasonable. When a recruiter reaches out for a new opportunity, you can actually explore it instead of immediately dismissing it out of fear. This flexibility and confidence often leads to better assignments, more recognition, and ultimately, more money. It's like having a secret superpower that you hope you never have to use, but that changes everything just by existing. But here's where most people mess this up, and I see it constantly. They finally hit $20,000 in savings, and they immediately blow it. They buy a new car because they deserve it after all that saving, or they book an expensive vacation, or they use it as a down payment on a house that stretches their budget. Don't do this. That $20,000 is not a reward for good behavior. It's the foundation of your entire financial future. It's the base that everything else builds on. Taking it out and spending it on something that doesn't generate returns is like building a house to 80% completion and then tearing it down to reuse the materials for a shed. It makes no sense. Let me give you a crazy statistic that'll blow your mind. The average person spends somewhere between $600 and $800 per month on transportation when you factor in car payments, insurance, gas, maintenance, and depreciation. Over a 40-year working career, that's somewhere between $288,000 and $384,000. If instead of spending $700 per month on a car, you spent $300 per month on a reliable used car and invested the $400 difference at 10% returns, you'd have over $2.5 million at retirement. Let me say that again. The difference between driving a new car and driving a reliable used car is literally the difference between retiring broke and retiring a multimillionaire. And yet, I constantly hear people say they can't afford to save for retirement while they're driving a $40,000 car that they bought new. The minute you drive a new car off the lot, it loses about 20% of its value. You just set $8,000 on fire for no reason. And then you're paying interest on a depreciating asset for the next 5 or 6 years. It's financial insanity. But it's normalized in our culture, which is why most people stay broke. Once you hit $20,000, this kind of thinking becomes impossible to ignore. You start seeing every major purchase through the lens of opportunity cost. That new car isn't just $40,000. It's $40,000 that could have grown to $100,000 or $200,000 over time. Is having a new car instead of a 3-year-old Honda worth giving up $150,000 of future wealth? For most people, once they really think about it, the answer is no. And here's the beautiful irony. The person driving the flashy new car is often stressed about money, worried about the payment, and stuck in their job because they need the income. The person driving the paid-off 2018 Honda Civic is steadily building wealth, sleeping better at night, and has the freedom to make career moves that maximize their long-term earning potential. Who's really winning? This opportunity cost thinking extends to everything. Housing, education, vacations, hobbies, entertainment. You start asking, what am I giving up to have this? Not in an obsessive way that sucks all the joy out of life, but in a strategic way that ensures your money is going towards things that actually matter to you. And here's what's funny. Once you start thinking this way, you often realize you don't actually want half the stuff you thought you wanted. You wanted it because everyone else had it. You wanted it because advertising told you to want it. You wanted it because you thought it would make you happy or impressive or successful. But when you really examine what you value and what brings you genuine satisfaction, a lot of that stuff falls away. This isn't about becoming a penny-pinching miser who never enjoys anything. It's about becoming intentional with your money.
It's about understanding that every dollar you spend on something you don't really care about is a dollar you can't spend on something you do care about. When you have clear financial goals and understand how compound interest works, it becomes much easier to distinguish between things you want and things you really want. Look, $20,000 isn't going to make you rich overnight. It's not going to let you quit your job and sail around the world. It's not going to solve every financial problem you have. But it will fundamentally change how you think about money and opportunity. It's the difference between surviving and thriving, between reacting to life and designing it. The journey from $0 to $10,000 teaches you discipline. The journey from $10,000 to $20,000 teaches you patience and shows you the power of compound growth. Every dollar you add after $20,000 works harder than the dollar before it. Every month gets a little bit easier. Every milestone comes a little bit faster.
So if you're sitting at $8,000 or $12,000 or $15,000 right now, keep pushing. The finish line isn't at $10,000. It's not even really at $20,000. But $20,000 is where the momentum becomes undeniable. It's where the math starts working so clearly in your favor that you can actually feel it in your day-to-day life. Start building that foundation today because your future self is counting on the decisions you make right now. Trust me, they'll thank you for it.